TD Economics has come out with its latest economic forecast. Here to discuss it with us is Beata Caranci, Chief Economist at TD Economics. I was going to start off by saying this looks a little more optimistic, but now that I'm looking at it, I'm not sure that it is. And you talk about the U.S. outlook saying it's inching closer to normal. So let's just start, if we can, with maybe where the growth has been and what you see it for the third quarter and moving ahead.
Sure. So one of the areas of strength in the U.S. economy is definitely the consumer. So we had basically a blowout quarter in the second quarter with consumer spending at over 4%. And I think if you look at GDP headline, which is the one that gets quoted in the newspaper, makes the flashy statement, the first half of the year was actually quite disappointing. It was only expanding by about 1%. Which makes you wonder why, the Federal Reserve would ever be considering raising interest rates with only 1% growth. However, when you scratch beneath the surface, a lot of that disappointment came through an inventory cycle correction, which is not expected to continue. And that was a big one, and some weakness on the business investment side, where we're already starting to see some life come back into it. The one thing that was consistently and persistently strong was the consumer. And so that remains the mainstay of that forecast, that the spending remains strong, which means that confidence must be pretty good in the U.S. consumer. We're seeing strength in wages and earnings, and employment is holding in well. So all those factors.
I want to dial in, if I could, on the investment side, because I always think, when you hear this, that the consumer is strong, but they can only be so strong for so long. At some point, that business investment, I think, is going to catch up. Mm-hmm. What are you seeing there in the investment side?
The investment, in terms of the weakness we're seeing, this is really a global phenomena that we're talking about, and this is what you're hearing a lot of economists talk about, this productivity puzzle. So why in a low interest rate environment do we continue to see investment underperform relative to expectations? And there's a lot of theories out there. I won't go through them. It's way too many to list. But I think ultimately it comes down to the fact that when businesses look out into the future, they're only looking at demand out of around 2%. That's the potential growth rate for the U.S. economy. And for those that are multinationals, depending on where they're operating, they may even be looking at potential growth of about 1.5%, say, if you're in Europe. So it's not a big catalyst for large spending initiatives to come on board as a result of it, even in a low interest rate environment. But the hiring and the payrolls has been quite strong, which is a good sign that there's a great deal of confidence out there and there's sufficient aggregate demand to create that hiring impetus. And in fact, the market's tightened up so much that we're seeing pretty good wage growth start to come through in a number of measures, like the Atlanta Fed measure as an example. And we're also seeing inflation metrics hold up much more stable than what you're seeing in Europe and elsewhere. So that combination of factors, I think, is giving us some confidence that, the Fed really is in a different position than what you're seeing from the ECB in Europe and the Bank of Japan. They could actually raise interest rates at this point, very gradual. We're thinking one hike, maybe every 9 months, but certainly start to get off the floor and normalize those rates a bit.
One thing that you do highlight, I think, in not just the U.S. Outlook, but when you take a look at your quarterly outlook for the entire world, you talk about, and I'm paraphrasing here, that growth is low. The central banks are gonna keep on doing what they're doing, with the exception of the Fed. We'll put them aside for a second. But you could see more turmoil, political turmoil, U.S. elections, Brexit, those types of things coming there. How vulnerable would you say is, just to shift to the global economy, is the global economy to these kinds of things right now? Because there seems to be more and more.
There is. It's almost a steady state of that, isn't it?
Yeah.
We're all getting used to that, and I think that's part of the complacency that, in terms of financial markets, that we saw over the summer. We saw a lot of money flow back into emerging markets because of the search for yield sentiment, with the notion that really central banks outside of the U.S. are not going to be in a position to increase interest rates for years, right? At best, they might stop adding stimulus into the economy, but at this point, they're still doing even that. So in terms of the vulnerability, I think it speaks to the point that the global economy is in a lower structural growth rate. And it's about, in terms of aggregate, 3% growth for the global economy. Historically, it's been about 4%, and some might put that estimate even slightly higher. So you've shaved a point off of your running speed, and that gets you a little bit closer to that zero mark. So you are more vulnerable when you have economic surprises or geopolitical shocks, because you have less room underneath you to absorb those nuances. And so that's what we're feeling all the time, is that we're continually feeling these cycles of dated disappointments and this pull down to these trend rates of growth. So if you take Europe, for example, if their running speed is only around 1.5% on a good day. I would actually say it's closer to 1. that doesn't leave you a lot of room for a data surprise on the downside. It would quickly flip you into zero. And so this is why we're seeing so much volatility in the markets as this constant push and pull factor keeps happening.
You highlight the fact also that policy coordination is really is the key to, and just to quote you directly, is eluding stagnation in the advanced economies. But what are the chances of having, I mean, you think about anyone trying to coordinate, it never seems to happen.
Yeah, so policy coordination in this case isn't necessarily between central banks of different governments, it's
government
within
and
the country. Yeah, so what we're talking about is you have two policy levers you can pull. You have the monetary policy and you have the fiscal policy lever. And right now, the lever that's being pulled and almost to exhaustion is the policy on monetary, right? So this is the quantitative easing, the negative rates, it's all the shots coming out from that side of the policy toolkit. And what's been underutilized is the fiscal side. And if you think about what are the challenges that the global economy is facing, it's aging demographics, which naturally leads to lower productivity. So you have these, and say, take Japan for an example, with literally a contraction in their population and not having immigration policy sufficient to offset it. So their population keeps getting smaller, their labor force is subsequently paralleling that. And that lowers your trend rate of growth. So what's a quarter point cut really going to do in that environment? You need fiscal policy. You need to either alter immigration policy or simultaneously increase your labor force and participation rates, which is actually what they're trying to do, but it's not something that you do overnight. It's a very a slow period that happens over years and years. So monetary policy can stopgap until you get to that end point, but it can't really fix what's ultimately ailing the countries.
Especially, again, with the advanced economies. Now, if you go to the emerging markets, which you highlight in here, you look to China, you look to India, all with, I'll say, good demographics, I would say, from a growth standpoint.
China, not so much.
No?
Yeah, no, China actually has very much aging demographics. What China has that other emerging markets doesn't have is a high population base in the rural part of their country. And so what they're trying to do is urbanize that portion of the population. So it's almost like a false population growth because you're taking people in the rural sector and trying to move them into the cities. And that gives you, and get them into like services and more productive areas of the economy. So that actually provides an offset to the fact that they have an aging population. But India, for certain, has very positive demographics.
And on the China piece, though, but you highlight as well, too, that the service growth is where you actually see the growth coming in that economy, too, because of what you just said.
Right, and that's exactly the outcome of it. So as it moves up the value chain and becomes a wealthier country over time, people gravitate more towards consumption of services versus goods. And so this is a big area where China's, you're starting to see a lot of growth, and in fact, services now account for a greater share of the economy than the goods side. Interestingly enough, their imports of services has actually gone up substantially. So it even shows you that we often think of trade, exports and imports of goods, tangible items, but it's been the services side that has been a steady eddy and the strong climb up. And one of the countries that has been supplying those services is the US. They've clearly been benefiting from the export of services to China. So it is one of these factors with some of the negative rhetoric happening on the trade side, even with the U.S. elections, that this is an area that they could end up cutting off this new, emerging market prospect happening on the export side for the U.S.
Fascinating. Let me ask you, just to pull back here then, when you take a look at your outlook, I'd say, for the next quarter, and again for the U.S. and for the world, I mean, what would you say? I mean, is this like steady as she goes, hopefully, fingers crossed, and nothing kind of derails it?
Yeah, the data always has a natural volatility embedded in it. But I think it's about getting expectations realistic. And so for the US, if you have GDP growing at around 2%, you're going to be eating up capacity, and it's going to get to a tighter and tighter market. Because of these aging demographics and the slow productivity growth, the combination that gets you that boost in GDP, their economy only needs to be running at about 1.8%. for it to be that steady Eddie state. So when you're growing at that or above, you're actually going to see labor force in terms of unemployment rates continue to go down, or at least continue to stay where they are, if nothing else, if people can participate to a greater extent. So it is an environment where it's about adjusting expectations of what is a good number in the U.S. Well, a 3% print would be fantastic, and 4% unheard of these days, except apparently for consumer spending. But 2% is where we really got to get our minds set on that is the norm.
Beata, thank you.
My pleasure.